Welcome to the Victorian Small Business Network, your go-to podcast for small business owners looking to connect, share and grow. Something I see quite often is that most business owners don't have a finance problem and they don't have a tax problem. What they actually have is a disconnect between the two. And that's exactly what we're talking about today. I'm Leanne Watson, your finance angel, and I help my clients fulfill their dreams and goals by accessing other people's money. I am a mortgage broker, although I prefer to see myself as a mortgage and finance planner. Today I'm joined by Felicity Belmont from Tax Espresso. Felicity is a chartered accountant, tax strategist and founder of Tax Espresso, where she helps Australian entrepreneurs grow their business with clarity, calm and complete financial confidence. With nearly 2 decades of experience in corporate and specialist tax, she's guided everyone from startups to multi-entity businesses through complex strategy, structuring and compliance, all without the jargon or overwhelm. As someone who's seen brilliant business owners held back by confusion, fear or shame around money, Felicity is here to rewrite that story with heart. Her mission is to give business owners back their power, helping them lead with clarity, own their numbers and fall back in love with their vision. She doesn't just decode tax, she helps you fall back in love with your business by making your finances feel lighter, clearer and more aligned with your purpose. So what if tax could feel like a superpower instead of a source of stress? That is a great way to look at it because for a lot of people, that's not how it feels at all. When you're working with clients, Felicity, where do you see that start to break down?
So the biggest thing that I find when working with clients, they come to us already stressed and overwhelmed. They have worked with accountants in the past that have not explained things to them, or they're starting afresh and gone, they've heard so many things out there and they're so confused. The biggest part we find is listening to our clients, working down and breaking down what their goals are, what their business is, and then working through their hesitations or their overwhelmness and stress. What is a business activity statement? What is company tax? What does a sole trader mean? A lot of those simple terms haven't even been explained to some business owners because people assume that they should know that already. And the first question I get from a lot of people is going, please don't judge me because I'm not actually sure on what this means, or I feel like I should already know what all the tax side of things because they're running a business. But that's not expected at all. Like, businesses shouldn't be expected to know the ins and outs of tax or ins and outs of their numbers on the profit and loss or a balance sheet. They know how to run their business. And what I try to explain to our clients is really, you are best at what you do. You run your business in it, whether you're a hairdresser, whether you are building a construction building, you're best at knowing the regulations around what buildings. Don't ask me how to build something. I don't know how to build anything. But I can explain to you the tax side of things. I can explain to you the numbers side of things. And we break down those barriers in simpler terms. If you're talking to a client, how would you talk to, if you're talking about mortgages or to someone who's running a business, it's not just suddenly using all these words over the top that they're sitting there going, I don't know what any of that means.
Yeah, and what I find when clients come to us is that so many people are either afraid, they're debt averse to using debt. What they don't really understand is that debt can actually be used strategically to help them grow their business. And that's all about understanding what you were saying, your goals and your dreams. Where do you want your business to go? How do you want it to be structured? A lot of businesses start at the sole trader level because that's the least expensive way of starting out in business. Where would you start to suggest to somebody that they would move from a sole trader entity in their business to a company? And what would be the difference between having a company and having a company and a trust in accounting terms?
Again, it always depends on, we start with what is that individual or family group's goals. Because I could throw out a number and I said, all right, you're a sole trader. When your profit is starting to hit around the 130 mark of profit, because that's when you're hitting the higher marginal tax rates, then we would consider whether we have the right structure in place. However, you've probably heard with a lot of accountants or a lot of people in the finance, it does depend. And it depends based on, for us when we're working with clients, what is those family goals? What is your 3-year, 5-year strategy or thought process of where do you want your business to go? And have you got a team around you? You might need your finance. You might need some lending to help you build that business. You might need you might need the liability protection. So you might actually want some income protection side of things of putting the structure in place for asset protection. So there's actually other things outside of tax that we would also look at. It's not simply the best tax saving. I know everyone thinks accountants are here just to save you tax, and that's where, and don't get me wrong, we can save you tax. But it's also the structures we put in place aren't just solely for tax. It is for a lot of reasons of building family growth, family and wealth, and what your goals are. And then also one thing that I think a lot of clients do forget about is looking at that 3 to 5 year goal of going, do they want to buy a house in the future? Do they want to buy an investment property in the future? Okay, how would certain structures influence that? And I think you when it comes to, we've had this conversation where it's, when you're looking at a loan when you're helping your clients look for a mortgage or look for a business loan, how do structures come into play?
And structures actually is a really good point, because that makes a huge difference. A lot of clients come to me, they've done all the structural work with their accountant and made sure that everything's covered tax-wise, but they might have been a sole trader and now they've moved into a company structure. What they don't realise is that their ABN has changed from the sole trader to the company, and that means that realistically, to get the best rate with a lot of lenders, you've actually got to wait another 18 months to 2 years before you can borrow at a reasonable rate, even in the alternative document space. So that's where a conversation, not just with your accountant, but with your mortgage and finance broker comes into play, because you can say, hey, look, we're at a level now where realistically, tax-wise, we're better to move into a company or a trust or a company and trust structure tax-wise, but do you want to borrow money in your individual name for property, for vehicles, for anything outside of the business? And so when is going to be the best time to actually make that structure, to make that structural change in terms of how it impacts your lending going forward?
And the biggest thing I think where clients need to understand, and this is where we have those conversations, we go beyond what you might see as a typical accountant conversation. We talk about clients' goals. We talk about clients' visions for what they want to grow into. And we really, how we operate with our clients is we sit behind their vision. We want to support their vision in growing everything. We want to support that they want to grow that business because they really want to go and help people in what they're doing. Now, a lot of accountants might look at this and go, well, okay, we're looking at our numbers and how that's all going to incorporate. And as you said, if I just set up a structure solely based on tax purposes, when they come to me in 6 months' time and say, oh, they need some cash flow because they want to expand this business here, or they're struggling with cash flow, if I go and send them to you, you're going to say, well, hang on, your ABN hasn't been even registered for 12 months yet.
Yep.
So we're going to fall down at a problem. So what I try to do when any structuring conversation doesn't revolve solely around tax. It always says, here's the questions of, let's go through those future plans. Okay, whatever the type of business is, do you need funding for? We work a lot on the online space with businesses who are online. You've got some digital marketing businesses, you've got products that are, whether they're drop shipping businesses and whatnot. If you're doing any sort of Google advertising at the moment, you might need cash flow.
Absolutely.
Because you need cash flow to send that advertising out before the money comes in. That might require credit cards. It might require loan funding on business loans, or personal funding where they might be wanting to reborrow against their home mortgage to help fund the business. Those conversations need to happen at the start.
Absolutely.
And it's all based on, well, what kind of business are they doing? Are they doing a services or a product business? Do they need the cash flow sort of into there? And I will say a lot of small businesses need cash flow. So it's all about then connecting yourself with a mortgage broker, or as you said, or was it mortgage planner, mortgage and business planner, loan planner? Because one thing I find is and it's really trying to change the mentality around clients, is they always see us as separate. They go and have their conversation with the mortgage planner, then come back to the accountant and then say, oh, my mortgage broker needs this. So one of the big things I find with clients is they don't involve everyone as a team. So when they say the mortgage broker sent them to needs this from the accountant, okay, my accountant, can you come and do this for me? I say, can you introduce me to the mortgage broker via email, give me authority to talk to them, so and vice versa, so that we can discuss your financial needs and what your goals are to put the best thing in place for you. Because they don't see that they're having conversations with either party, but it's just not the same conversation. If you're having a conversation, if you're sitting down with your mortgage broker, get me into that meeting, because we are already part of your financial situation. We already need to know what's going on. If we're already involved in that half an hour to an hour meeting with you, then we can not have to do the back and forth on the other end of it, which is still going to be, if not longer, where we can hash things out at the one time.
And that makes so much sense. I've actually had clients ring me and, they're wanting to do this or wanting to do that or whatever. They've got companies and trusts and everything all over the place. And it's about having that conversation and saying, well, which entity is actually going to be the right entity to borrow in? Are you wanting finance to grow your personal net worth through property? Are you wanting finance to actually grow your business? And which is going to be the best entity to actually have that in? Even a lot of people don't understand that they can borrow money a lot more cheaply if it's secured by property to grow their business, and then they can go to their accountant and say, hey, look, I've taken out this money against my property, and you can have a loan contract in place so that the interest is actually charged. And that's a conversation with both your accountant and with your mortgage broker, and getting that all set up before you actually apply for the finance just makes it nice and clean and smooth, because it means if you're borrowing money for your business against a personal asset, then that money needs to go from the personal asset when the loan settles into the business banking account. So you've actually got that paper trail for your accountant, and you're not going to have arguments in the future with the tax department because you're lending money to your business.
Oh, correct. And it's the biggest thing of working with a mortgage broker that knows what to do in that situation. So the amount of times that I've spoken to the client and they've gone, oh yeah, my mortgage broker, definitely not you. I just wanted to use that disclaimer. But we've got clients that might come to us and go, oh yeah, we borrowed some money against our home, but they pulled out extra equity and kept it as the same large sum of money. It's like one loan, rather than breaking it into multiple loans against the same property. For tax deductibility purposes, having that, say they might want to go and borrow $100,000 to help support their business. That $100,000 should be showing as a separate loan against the property. You can have multiple loans against the one security. And that just helps with the deductibility and the streamlining without having to do what we call tracing and looking at how much, when you've got your main mortgage, I'm going to use an example. You borrow $100,000 for your business, but maybe you've got $400,000 owing on the house that's completely private. If you're wanting to put extra funds on your property because you want to pay off your mortgage quicker, if that whole loan was $500,000 instead, and you're putting those extra repayments on, you're reducing the deductibility of that $100,000 at the same time. But if you're putting all those extra repayments on the $400,000 loan only because they're separate loans, we keep the full tax deductibility on your business loan. And the biggest thing, especially with refinancing, I find this biggest thing with refinancing is that you might be with one bank and you've got those separate loans. And if you're not working with the mortgage broker and the accountant are working together to ensure that these loans are working together properly, you could refinance to a whole nother bank and just join them and amalgamate all those loans together, because some mortgage brokers sit there and go, oh, well, why do you have so many loans? And the client's like, oh, I'm not sure. It's just the way it was set up. It was just set up that way. Oh, well, we can streamline that for you. We can put it all together. Oh, yeah, okay. But there was no conversation with your accountant and with your mortgage broker jointly talking to say, no, that's been set up like this, and this for this purpose. And the client may be unaware. Now, we would have explained it to them, but this could have been 3 years ago when it was set up. So having constant communication as part of your team. So the way we work with our clients is really, the way with any clients who, when they have a business, is you have a supportive team around you. That doesn't have to be an in-house team. That is the external team, being your tax advisor, your mortgage broker, your financial planner. All of these people are part of your main business advisory team.
Absolutely. I actually have a story that a client, she was buying an apartment right next to hers, and she was going to merge the two properties together underneath the one roof so that it became one super large apartment. When we actually did the loan, it didn't make sense because that was going to happen within the next 6 months. When reality hit, she decided that she couldn't kick the tenant out of the apartment that she'd bought. And so that continued to be an investment property. When I realised that, I said, hey, look, let's restructure the loan and make it two separate ones. So you've got your investment one and your personal one. She said, oh, no, don't worry about it. Go and have a talk with your accountant. She said, no, it doesn't matter. When it came accounting time, she could not pay the home loan down more quickly than the investment loan. They all had to come down together. So she missed out on that tax advantage. About 5 or 6 years after we had done that, she wanted to buy another family home. And I said, well, this time we're going to sort it out so that it's all in its right buckets. Mm-hmm. So she had 3 or 4 investment properties, and they'd all got mixed up previous to me working with her. The accountant and I sat down. It took us hours and hours of time to work out what amount of loan was owing on each of the different properties. And that could have all been saved if we had done that up front when she first decided that she wasn't going to turn the apartment that she was buying, that was going to be owner-occupied, and left it as an investment property. So it really does make a huge difference as knowing what you're going to do. But even if you change your mind, actually doing the work at the moment the mind has been changed, so that you don't have hours and hours of work in several years' time to get it back to where it should be.
And I think that comes down to, a lot of people think I need to save money at the start. I need to do, if I save some here, and they don't really see the ramifications down the track. But honestly, if you would put the time and effort into just speaking to the accountant right from the very beginning, having that 1 hour, I'm talking like a half an hour to an hour meeting that would have hashed out any of those issues straight from the very beginning.
Absolutely.
And saving that cost right from the very beginning, because the hours and hours of time that you would, and this client would have been charged for that from, completely. The accountant would have easily been charging for that fix up and mess. But it's because people don't actually see that the need for the inclusion of the mortgage broker and the accountant in the same room. They keep people separate, because accountants are seen, unfortunately, is very much seen as the once a year tax time kind of consulting, and here's my tax return, complete the financials, complete the tax return, and you're done. Yep. That's not how it should be.
No.
So the way we work is we are proactive, because you need to have. We don't actually take on clients like that. I'll say that. Probably a bad thing to say, but we work with our clients as a proactive, and we touch base with our clients every quarter at a minimum. If they don't touch base with us every quarter, then there is an issue going on. Usually we prefer to touch base with them monthly, and we do that in a structured way so that every decision they're making is if it's a business decision or a personal decision. Because a personal decision could be they're looking at another investment property, or they could just be refinancing the home loan.
Yep.
Now, those decisions can impact how they're doing overall with tax purposes, and then working with the right advisors. So as soon as I get them saying that, I'm like, cool, I'm going to connect you with my mortgage broker, who, Leanne, is a fantastic one to do that. And it can help with the cash flow things as well.
Yeah, and that is actually so important, because if you're self-employed in particular, then your personal and your business are actually
one and the
same. So, there are a couple of lenders these days, if you're buying property, where you can, if you're taking enough proper salary as wages and paying yourself super, that we can do it as a simplified lending just on the wages. But there's not that many lenders that do that. So you really do have to have those strategies in place before you come to the lending. But if you have just rearranged your structure in terms of your business, then that can be a huge impediment to actually getting more funding. So it's really getting clear on, what do I want to do, both personally and business-wise, and understanding that those 2 points are together, but they also need to be separate. My biggest bugbear as a mortgage broker is when people come to me and they've got only one account, their business account, and they do everything out of it, all their personal shopping, all their business stuff, and that makes it so difficult to work with. Because if you're self-employed, you've actually got more options than a lot of people who work for somebody else, because we've got fully documented loans where you have 2 years, worst case scenario, 2 years tax returns that can support your income. But we've also got access to alternative document loans. And a lot of these aren't that much different in interest rate and cost to get in these days as a fully documented loan. So we can use bank statements, we can use BAS statements, and there's the accountant sign off on the income that you're declaring as well. But if you want to use bank statements and you've got all your personal stuff mixed up with all your business stuff, how much more difficult is that to get a loan than it is if you've got your business stuff out of your business loan and your personal stuff out of your personal loan? Even as a sole trader, you can have a thing, we used to have a thing called physical distribution when I was back in the sole trader days, and that's where the income went from my business account to my personal account.
Yeah, and then you can have your personal account using that to spend money.
Yeah.
When we have our initial meetings with our clients, when they're coming to us, when they're setting up, it is definitely the conversation of going, you need to have a separate bank account. Don't be using... Now, you've just used a great example as to how it's even going to affect your mortgage. But clients, unfortunately, don't realise that. They kind of just go, the time it's going to take me to go to the bank and just set up an account. Now, nowadays, we can set it up online pretty easily on the same platform of who your normal banker is for a sole trader. So the importance of having those separate accounts, even for tax purposes and bookkeeping purposes, if you're running a sole trader business, if you've got constant private expenses through your account, the nightmare of bookkeeping to go through that and to separate that out, and we work with our clients to make sure they're doing the things on a quarterly basis. We have had clients come to us, and this is very common, they don't do anything for the last year's until they're going to see the tax person, which of course is about 18 months, after the start of the period. So they're only just, collating all that information for you. But it's sifting through bank statements that have private accounts all through them. It's a nightmare. So imagine how much time they're losing where they could be focusing on the business. And then when you look at a mortgage broker, it's like, well, how much time are you wasting trying to find... Unfortunately, it's having those conversations with clients to sort of say, okay, it may cost you more time initially to set it up, but once it's set up, it's going to save you so much time in the long run. Similar to setting up the right loan right from the very beginning. It's all about having those structures and the foundations right with any business and personal situation. If you get them set up correctly at the start, yes, you might be putting a little bit more time and effort into it at the start, but it will save you so much time down the long run.
Absolutely. And give you so much more flexibility with what you're going to do as well. Because the one thing that the government has done here in Australia is that we're all in boxes. You have, as an accountant, you can talk to people about their tax and the entities that they borrow money in. As a financial planner, you get to talk to people about how they grow their wealth. As a mortgage broker, I get to talk to people about their loans, but there are three separate buckets. And so unless you've got your mortgage broker, your accountant and your financial planner in a conversation with you about what you want to achieve and how you want to achieve it and a timeline around achieving that, then everybody is working in isolation and they can be cutting each other's lunches in terms of how you move forward with ease and grace, as opposed to going forward in the chaos of trying to correct something that's been done incorrectly.
Correct. So if you can just jump into it, if you have your three, as you said, the three pillars of the building your wealth and future, if you have those three people in the room with you discussing it, you can then go over one. For you, it's saving time. For the client, it's saving them time. They don't have to explain the situation 3 different times and then have to place that call back and forth all the time. And then the bouncing of ideas back and forth between the 3 of us in a room will solve the solutions so much quicker.
Oh, absolutely. It's so much easier. And I'm continuously saying to my clients, have you thought about this? This is what I think that you should be talking to your accountant about before we do anything with the loan, because that way we know that structurally it's going to be the right thing for you at this point in time moving forward. So I can't give accounting advice, but I've been in the industry for long enough to know what sort of questions my clients should be asking their accountant.
Yes.
And that is, I just think that's so important. And the amount of money that it can save people, both real money that's in their pockets, but money that they can save on tax, and making sure that they've got that trail for the tax office that is clean and pure, and it must be a lot easier to work with as an accountant.
It is a lot easier. And it also, as you just said, the tax office will go and look at these. If they need to scrutinise something, then if it's a mess, it's going to take, the accountant's time to do it, and the auditors or the ATO auditors will be looking at this going, is it actually correct this way? I think we're going to, they'll be thinking there's something to hide. But if you have it clean from the very beginning, if you get a letter from the tax office and they're asking for more information or something, if you can just go bang, 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 here's all the information, no issues, it's all there, and give it straight to them, they'll walk away and they'll go tick, 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 all good.
Yep.
Whereas if you have to go, oh no, it's a bit over here, oh no, it's a bit over here, it's a bit over there, hang on, can we get some more time to work all through this? Well, then suddenly they're going to be like, what are you hiding?
Well, what else is going on here?
Exactly. So it can, having those systems in place from the very beginning. And it's another situation, if we go back to when you said, well, when is the right time to go from a sole trader to a company, or if I have a client coming to me with a new business, that's where we may also say, go into a company from the very beginning. We may say, like, yes, you could turn around and be a sole trader for 6 months and then go jump onto a company, or for a year and then jump onto a company. However, in 2 years' time, if you're wanting to expand the business and borrow some money for equipment and things, then maybe jumping onto a company structure from the very beginning might be the best option, or a trust structure, depending on how we're doing it. Instead of going, okay, well, we can set you up as a sole trader now, but this, and we, at the end of the day, we can only give them the pros and cons. We can go the disadvantages and advantages of both sides of things, and our recommendation based on the business that they're doing. So for us, it's really, and it all starts back to having that detailed conversation, asking the right questions, and revolves around what their vision for their business is and their vision for their family.
Yep. And that makes sense as well, because if you're say a tradie, and you just want to be a sole operator from now until whenever, there's only so much money I would imagine that you could earn as a single operator in a trade business.
There's only so many hours in a day.
Yes,
it's
exactly
a service business, isn't it?
Yes.
So if you're not looking to hire someone else to help with that, then you can only earn, you're going to be capped. Now, you could be capped at, say, 200,000.
Yep.
But you're also your personal services income. So we have rules that we can't actually put it through a company, or we could put it through a company, but it would still be taxed in them individually. But they could be just going, oh no, and I have actually had particularly a plumber say, oh no, I don't plan to, I just want to just do it myself. I don't actually want to hire anyone because they don't want to deal with any staff. So they are going to cap themselves right at the very beginning, but they're happy and comfortable with that option. But then we can work through that and go, okay, so this is where you're going to go with how we're only going to be capped out at X amount of per year. So a sole trader obviously is probably going to be the main protocol of that.
And the thing is that he's not limited by that going forward because he can change his mind.
He can definitely change his mind. He could turn around and say at any point in time, going, actually, you know what, a fully qualified plumber might be really handy for me. Oh, maybe I will hire
taking on an apprentice.
Or taking on an apprentice. So they can always change. They can do that. They can take on an apprentice and take on staff in a sole trader name as well.
Yep.
But there's flexibility a bit more and within the company structure on what they can do.
Even when things are structured well, there's often still a gap between what looks good on paper and what actually works in real life from a cash flow perspective. What I saw recently in an article that I was reading was the difference between profitability and bankable in terms of your cash flow. Now that sounds much more like an accountant term than a mortgage broker term.
Yeah.
So I think that's also something that business owners need to understand is how that works. If they've got those categories in their mind and they understand how they work, then potentially that's something that's going to make it easier for them.
Yeah, so essentially, look at a business like this. We have so many businesses that they can really feel busy. They're so busy every day, but then they've got a cash flow problem. Why do they have a cash flow? The bank doesn't tell me that they have any money in there, but they're so busy every day. Now, this can fall down to a lot of, they are profitable. They're sending out their invoices. They're paying their own suppliers, but their customers may not be paying in time as well. So you could be having a profitable business on one side, but there's nothing in the bank. So it's a cash flow issue on that side of things, as well as one thing that doesn't show up on a profit and loss. So your income less your expenses in a business is what other liabilities do they have to pay off. So cash flow statements is what we look at for this in a very simple term, is you start looking at what your income is, less your expenses on a cash basis, then going, okay, well, what loans do I have to pay? Or what GST do I have to pay? Or what tax do I have to put aside for things? And so the one thing that we are definitely finding with our clients lately is the cash flow system of breaking down is that they're finding that, that customer is, their terms are 7 days, but what's their actual terms? Their terms are 7 days for their customers, but how often are the customers actually paying?
Yes.
So you've got your profitability when it says on one, but what's in the bank?
Yep.
So, and then it will also be, I guess, when it comes to what do you look at when you're looking at a loan for the client? So if you've got clients that want to get a business loan or an equipment loan, whichever they're doing for what they need, what does the bank look at?
Well, that depends a little bit on whether they're going to a bank, and big banks are the ones that will do unsecured lending, or whether they're going to a non-bank and they're doing more of a cash flow sort of a thing. So you've got a few different ways that you can access money to grow your business. If you go to a big bank, then you're limited on what you can do in what's called the residential space, the domestic space, and there are big restrictions about that because it costs, they make more money on the business side because business loans actually cost more, but you can secure business debt against your mortgages and on your home loan or an investment property. And then there is the non-bank space where a lot of the non-bank, the second-tier banks, don't do unsecured lending at all. So some of them, they really want to have a property involved in the process if you're going to get business money for your business with them. And then you've got the non-bank space. And a lot of the non-bank lenders, interest rate is determined by the purpose of the security as opposed to the purpose of the funds. So if you've got an owner-occupied property and you want to take some cash out for investment or to grow your business, then you can do that at owner-occupied rates. Now, those rates might be marginally higher than even on a fully documented loan than a second-tier lender. The big banks tend to be a little bit more expensive on the whole than the second-tier lenders. So then you can actually work out the numbers. Is it worth my personal mortgage going up a little bit so I can get my business money at a lot cheaper rate because I'm getting it at owner-occupied rates. And there's even some lenders in the non-bank lending space where interest-only and principal interest loans are exactly the same rate, so that can make a big difference as well. And most of them these days, there are a few that don't, but most of them also have offset. Well, they have loan accounts that can be used as an offset account. So that too makes a big difference in how somebody can utilise a mortgage. And then we have what's called a cash flow lender. And there's some out there where the interest rates are up there with top quality credit cards in the 20s. But then there's other lenders in that space that are actually not that much different to a bank in terms of their rates. I have done some sums for a client recently. They had $150,000 line of credit with $140,000 loan on it with a lender that was up there in a really big way with the interest rate, and they had an ATO debt. So I'm able to, with a cash flow lender, I'm able to consolidate those two debts, pay them both out, get them another almost $50,000 in cash, and at the same time, I'm saving them $1,253 a week in repayments, and over a 4-year term. Once we get to 12 months of good behaviour on that loan, I can flip them out into a bank loan with no income documents and so long as the repayment is less than what they're currently on, then they can also potentially have some cash out as well, depending on the loan amount. So that saving of $1,253, that's actually $65,500 a year. And that's an unsecured debt. If they were willing to put one of their properties up, because there's 4 directors involved in that transaction, then we could drop that interest rate down another % and as well. So that's really putting them in a much better position now they've reached another growth stage of their business.
Yeah, and it's amazing just looking at that saving, as you said. Did you say 65,000?
65,500.
65,500 a year. And that is amazing to say all that was just, okay, let's go and have a look at your loans of what you're currently doing. Because a lot of clients that we find, they go straight to, say, those bigger lenders, not bigger lenders, the cash flow lenders, and, do the application online and just get some extra cash flow, but they don't go and physically speak to someone who can assess the full picture. And then it's, the idea of saving 65,500, whoa.
I mean, they are turning over sort of $900 to $1 million a year, so...
I think I need to refer you. Some of my clients might be coming your way soon to just have a good review. So I think that leads on to a great point that if you haven't reviewed any of your loans in your balance sheets, anything that you've got sitting there going, okay, business and personal, it needs to be reviewed.
Absolutely.
Definitely needs to be reviewed. Now, the other question I did have for you, so obviously you're talking about low doc loans and different types of fully documented loans.
They're not low doc loans anymore. They're called alternative document loans.
Alternative document, thank you for my correction.
If you want a short version, it's alt doc.
Alt doc. Oh, now I'm getting the terminology for the mortgages. So if we had a client that we were talking about the profitability and the cash flow. Now, I know we've spoken to this before, but you talked about documents that can be provided for a business for one of those loans. And I think you were referring to that they can look at business activity statements.
Yes, absolutely. Yep.
So something to note with that when we talk about profitability and cash flow and things like that, a lot of our clients, depending on the turnover for our client, might be on a cash basis for those BAS statements. Mm-hmm. So that can also deter for when we're talking to our clients, they might see that their profitability for tax purposes, well, they've got to pay tax because when we lodge their tax return, they've made money based on their accrual basis. But when it comes to cash, that might be that discrepancy in where they're going.
Yeah, so they've got the cash flow. It's just that when that cash flow translates to tax returns, it's actually not the same thing.
No, they're very different. And that's where walking through that aspect of saying, well, it's because they might have your accounts, your customers that aren't paying. Trying to use the right terminology so it's simpler. It's making sure that you can actually differentiate between what's going on in the business and what do they need and how can they, what's documentation. One other thing is, it goes back to the importance of talking to your mortgage broker, having the team and advisory team around you, is I want to say going and buying an asset. So when we go, we've got clients that will obviously leading up to 30th of June. Leading up to 30th of June, we have so many people come in and say, well, what can I do to save tax? Can I go out and buy this truck over here? Can I go and buy this new printing machine that we need for the office? And I think you've been telling me that there's options available leading up to 30th of June.
Absolutely. At the moment, a lot of the cash flow lenders have specials on for just this time of year when people are looking to work out where they can save some money tax-wise, and if they're a more corporate company, they have budgets in place, and often they leave it to the last month to make sure that they've got the cash flow around to actually support that section of their cash flow, their budget that they've set aside. So it is a good time to be looking. Some of them will have repayment holidays, so you don't pay any more interest, but you can have 4 to 6 weeks of not having to pay the loan down, and then the loan term begins from the end of that interest-free period, if you like. So there's lots of options around leading into the end of the financial year for business owners.
Yeah, and leading into the end of the financial year, we, as an accountant, we always have those tax questions going, oh, how do I save tax? I will advise that the main thing I do say to clients is only go out and buy that asset if you actually need the asset. Because at the end of the day, you are only saving the 25% company tax rate. So you're still out of pocket 75% of the, you're going to be claiming a tax deduction for it, but you're still going to be forking out 75% of the cash flow. Or if you're in a sole trader, you might be, depending on your turnover, might be, say, 37%. Yep. So you still, whenever it comes to any sort of run out and buy the asset, and I know that a lot of people go out to they go to the car dealerships and go, oh, you need this truck, and we can, it's the end of financial year, it's a tax deduction. Or it's go into any computer shop and, I need some more computers. Upgrade your computers. It's a tax deduction. That tax deduction wording simply means you're going to save your marginal tax rate or company tax rate on that. So it's 25%, could be 37%, could be 47%, depending on where they're at in the scale. But it does lead into a really what you've said is that it's a great time to pick up a deal if you are looking to, if you've already got a car or equipment that needs to be, or any sort of business loan, it's a great time leading into.
Or if you want to buy stock.
Oh yes, definitely buy stock.
Or take on new staff members. Yeah. Now is the time to really be doing it if you want to use other people's money to be doing that.
And so if realistically, obviously we've got the end of financial year is 30th of June, when would be the best time? Would you say about 3 months or 2 to 3 months before the end of financial year?
So about now. Actually, I don't know when this is going to come out. So
that's why I was trying to reword it to me a bit.
So about April, May is a really good time to be sitting down with your finance team and working out, is this going to be an option that I can actually use? Making sure that by the end of May, you've got applications in place, because it's the end of the financial year. You're not the only business owner that would be thinking, how can I do this? So the lenders actually have everybody coming at them. So time is of the essence if you want it to settle by 30th of June.
I completely agree. When it comes to tax planning as well, picking up a phone to your accountant in June is not going to get you very far. I could tell you some very quick wins, but they're not going to be, the bigger aspects. So whenever we look at tax planning, it's always around that April, May side of things, because June's just, what can I do? Just pay a few bills up front. There's not a lot you can do. You're not going to be able to go out and buy that motor vehicle and have it delivered in your office, in the car park by 30th of June.
Yep.
It's just not going to happen. So I agree with you. If we look at any sort of tax planning and purchases and loans, April, May.
Yep. It's definitely all got to happen by then.
Yep.
So I think I don't know about you, but I've really enjoyed this conversation. And I think what really comes out is it's not about having everything perfectly figured out. It's about having the right conversations at the right time with the right people around you to make really good quality decisions. So if you're listening and something we've spoken about resonates for you, then give us a call. Have a chat. Felicity or myself, we love having chats, as you probably can tell. And Felicity, I'd really like to thank you for coming along today and being my guest.
Thank you for inviting me, Leanne. And yes, I think definitely if you're ever having that conversation, have your team in the same room together is the way to go about it.
And these days you can do it virtually as well as face-to-face.
Correct. So it saves
there's
everyone's
no
time.
excuse.
No travel time required.
Yes, that's exactly right.
Exactly. Well, it's been a pleasure, Leanne. Thank you.
Thank you. Our details are in the description below, so if you want to get in touch, please do so.